The market will be digesting the latest Fed decision today and will be doing so as U.S. equities continue to run to record highs over a decade after the 2008 crisis began. Investors have continued to buy stocks at every turn on bets the Fed will keep its lower for longer strategy in play. While this strategy seemed to be exposed heading into 2019, it has held to form reliable as ever, with the Fed doing a drastic 180, moving from an outlook of rate hikes to an outlook that is once again considering rate cuts. And so investors keep on living in this perfect Goldilocks world where Fed policy and government stimulus efforts have resulted in economic data that shows a recovery in the U.S. economy, but not enough of a recovery to keep the Fed from thinking about more rate cuts and a policy outlook locked in lower for longer land. Lower for longer means free money to those who can access it, with stocks standing out as the most attractive game in town, even now. And yet, it's important to understand that stocks might be the most attractive game in town, but it's also because they've been the only game in town by design. This makes everything a lot less encouraging beneath the surface, as it reminds us that the euphoric run is a lot more fluff than substance, making it highly susceptible to intense capitulation whenever a catalyst comes along that can not be ignored. One such catalyst would be that thing that has been absent for so long, that has had the best of Fed members scratching their heads. That thing is inflation. An absence of inflation has given the Fed the luxury of being able to err back on the side of accommodation. And so if inflation readings do start to turn back up in the coming months, this could very well be the catalyst that has investors running for the hills, with the Fed no longer in position to be able to lean to the accommodative side, forced to consider a balance of risk that has it worrying more about financial stability and fallout if rates are not adjusted higher to combat rapidly rising inflation. But again, at the moment, there are no such signs of inflation, and this has kept things moving along as they have been. President Trump has put more pressure on the Fed in the lead up to today's decision, expressing his criticism of a Fed that he believes should already be delivering a steep rate cut and fresh QE in light of what has been very low inflation. But this is consistent with the president's line over the past several months, and the market hasn't been all that surprised to hear such words from the president. As far as today goes, the broad consensus calls for the Fed to leave policy on hold, with most of the attention on what the Fed chair will have to say in his post-decision statement. Powell's tone is likely to be one that is more balanced, with the Fed chair to project a patient approach while the central bank monitors the balance of risks. Clearly, we've already seen a big adjustment in Fed policy in 2019 that has leaned to the dovish side, and it's worth considering any possibility the Fed chair leans further in this direction. One such indication would be if the Fed removed its patient language and replaced it with language suggesting the committee stands ready to act to adjust policy as necessary. But we don't believe the Fed will be this aggressive in the direction of ramping up expectations already there for a rate cut, and instead expect the Fed will possibly leave the door open for rate cuts, short of any official ramping up in the language of the statement. Anything that leans more dovish is likely to weigh more heavily on the U.S. dollar, while possibly fueling more melt-up price action in U.S. equities. Anything that leans more hawkish could support the U.S. dollar, and more so against the major currencies, with stocks expected to sell off on such a message, weighing on risk-correlated FX. Technically speaking, despite making fresh multi-month lows in recent days, the euro has already seen a massive decline of well over 10% since it topped out at a plus 3-year high against the US dollar back in 2018. Since then, we've seen a lot more dovishness already baked into the euro outlook, all while more Fed dovishness appears to still be on the cards. Volatility has also been super low in recent months, with average ranges coming in dramatically. All of this points to the possibility that an exhausted-looking dollar run could be about to turn. But more confirmation will be needed to strengthen this dollar bearish euro supportive outlook, and right now we would need to see the euro back above 13.25 to encourage this prospect. Until then, the dollar remains firmly in the driver's seat. That's all for now.